when you pull up a stock chart or like look at the price of Bitcoin on your phone, there's this illusion of reality. You see that green or red candle, you see the current price, and your brain just automatically tells you, oh, that is what is happening right now.
Right, yeah. Feels very live.
Exactly. But the truth is, you are only seeing a ghost. You're basically looking at the footprint of a battle that has already ended. To actually see the future, you have to look beneath that chart into the hidden hyperspeed battlefield where the real fight is actually happening.
It's the ultimate difference between reading the news and being in the room where the news is actually made. The chart is just the historical record. The order book, the actual ledger of bids and asks, that is the live environment. That's where intention is formed. So if you want to understand where price is going, you have to understand the physics of that specific room.
And that hidden environment is exactly the mission for today's deep dive. We are going to explore the mechanics of market microstructure and order flow. And to do this, we're pulling from a really fascinating source stack. First, we have a theoretical breakdown of market physics called the touch pressure law.
Really interesting paper.
Yeah, super dense, but amazing. And second, we have the incredibly intense, like almost sci-fi documentation for a piece of cutting-edge trading software called 3D NXUS Meta V7.
Which is quite a name.
It really is. It was built by a developer named Nico Z after 15 years of research and development. And looking at the documentation, it's designed entirely to exploit these hidden market mechanics. Okay, let's unpack this, starting with the physics. Because before we even touch the software, we need to understand the fundamental laws of this battlefield.
Right. The foundational concept here really revolves around how amateur traders view the market versus how professionals do. When an amateur looks at an order book, they are generally scanning for one thing, which is the biggest number.
Right.
They ask, where's the big size? So if they see a massive wall of buy orders resting slightly below the current price, they just assume the price won't drop below that. They treat it like a concrete floor.
Because it looks solid.
Exactly. But the professional asks a much more precise question. They ask, how close is that big size to the best bid or the best ask?
Right, because distance changes everything. Like, think of it like a physical confrontation. If someone is standing all the way across a massive football stadium yelling threats at you, that's information, right? You know they're there.
Yeah.
But it's not immediate pressure. You have time to react. You can change your strategy. But if that exact same person is standing 2 inches from your nose, stepping right into your personal space, that completely changes your physical response.
Oh, absolutely.
The size of the threat is the exact same, but the proximity makes it an immediate crisis.
That is a brilliant way to conceptualize it. The source material on the touch pressure law defines this mathematically. So imagine a scenario where a buyer wants to place, let's say, 150 contracts. If those 150 contracts are parked far away, say at the 4th or 5th level, down from the current trading price.
That's the guy across the stadium.
Exactly. The market registers the information, but sellers don't feel threatened. However, if you take that exact same size and you distribute 50 contracts at the absolute best bid, 50 at the second, and 50 at the third, well, the market meaning is entirely transformed.
Because now they're standing right in the impact zone. Sellers literally cannot move the price down a single fraction of a cent without chewing through that buyer's capital.
Right, they're exposed to immediate execution risk. By placing those orders right at the touch, the buyers are signaling aggressive intent. They're saying, we are willing to be filled right now and we dare you to sell to us. It forces the sellers to expend energy. The sellers cannot push the price lower without immediately spending their own market orders to consume those limit contracts. The source material puts it brilliantly, actually. It says, size matters, but proximity transforms size into pressure.
Proximity equals pressure. I love that. But I want to push back on this a little bit because I think a lot of people listening might fall into a logical trap here. I know I have in the past. If I'm looking at the order book and I see this massive, aggressive wall of buy orders stepping right up into the current price, doesn't that guarantee the price is going up? They're physically blocking the price from dropping. Can't I just place my own buy order right above that wall, lean on it, and ride the wave up?
Well, institutional algorithms absolutely rely on retail traders making that exact assumption. That's the trap.
Really?
Yes. The fatal flaw in that logic is assuming the wall is a static, immovable object. The mere existence of liquidity is not enough. You have to watch what happens when that pressure is actually tested by the market.
Okay, so how do we know if it's real?
The touch pressure law outlines 3 specific behaviors of liquidity that dictate what happens next, and it is rarely as simple as bouncing off a wall.
So it's about the reaction. Let's say sellers do attack. They throw market sell orders at this massive bid wall. What are we looking for to prove the wall is legit?
The primary behavior you want to see if you are bullish is absorption. So imagine aggressive sellers start dumping market orders, trying to smash through that wall of buyers. The visible size on the order book gets eaten up, but within milliseconds, the buyer reloads the bid with equal or even larger size.
Oh, like a video game boss, where the health bar just instantly regenerates the second you damage it.
Because
It's got to be so demoralizing for the attacker.
It is entirely about exhausting the opposition. It shows that the buyers aren't just bluffing to prop up the price. They are actively absorbing panic selling. They have deep pockets and are willing to take the other side of all that sell pressure. If sellers are exhausting their inventory and the floor simply isn't dropping, the probability of an explosive upside push increases dramatically once the selling finally dries up.
Okay, that makes sense. True absorption. But what if the sellers don't attack? What if the buyers place that aggressive pressure, but the price just starts to drift upward away from them? If they just sit there, they don't get filled right.
Right. And in that case, you look for the second behavior, which is migration. The buyer isn't just parked waiting for a discount. They actively cancel their orders and lift their bids higher, chasing the touch. If the price moves up a tick, the massive bid wall moves up a tick right behind it.
Ah, so they're stalking it.
Yes. It shows real order book aggression and sustained commitment. They are willing to pay worse and worse prices just to ensure they get into the market.
That feels like the ultimate confirmation. You have massive size and they're hungry enough to actually chase.
Yeah.
But there has to be a dark side to this. What happens when that wall is a complete lie?
That is the third and most dangerous behavior, the trap. In this scenario, large bids appear near the best price. The proximity creates that immense pressure we talked about. The price naturally starts to drift upward as smaller traders, the ones trying to ride the wave, front-run the big wall.
Like what I was talking about earlier.
Exactly. But those large bids aren't meaningfully attacked. And then, suddenly, they completely disappear.
You just cancel the orders, poof, gone. And anyone who bought above them is suddenly standing over a trapdoor.
It was an illusion. It was a classic bull trap designed to create a false sense of security to lure eager retail buyers into the market.
Wow.
Once those buyers step in and push the price up slightly, the fake support vanishes, the floor falls out, and the original entity that placed the fake wall often dumps their own sell positions onto the trapped buyers. They use the illusion of a floor to create exit liquidity for themselves.
This highlights exactly why you can't just look at a flat spreadsheet of numbers. If you are just looking at the existence of liquidity, you're going to get slaughtered by these traps. You have to be able to see the behavior of the liquidity over time. Is it regenerating? Is it chasing? Or is it fallograph?
And doing that manually, like tracking, vanishing, reloading, and migrating orders across thousands of price levels in your head, while prices fluctuate several times a second, it's simply impossible for a human being. The cognitive load is just too high.
Which is the perfect pivot to the tool built specifically to visualize this chaos. Enter the Combat Cockpit 3D NXES Meta V7.
I have to say, looking through the documentation for the software, it feels like I'm reading a manual for a fighter jet, not a trading terminal.
It really does have that aesthetic.
Yeah, they explicitly state it is not a charting tool, but rather microstructure warfare. And the terminology they use is just incredible. They have modules called the spoof warden for catching those fake illusion walls we just talked about, and tape bomb detectors for algorithmic sweeps. But the one that really caught my eye was the Iceberg Assassin. The Iceberg Assassin is wild because it addresses one of the most frustrating aspects of institutional order flow. Before we explain the module, we should probably clarify what an iceberg order actually is, because it's the ultimate tool for hiding true size.
Okay, let's unpack that. Say an institution wants to buy like 10,000 Bitcoin. If they slap a 10,000 lot bid on the order book, the entire market sees it. Everyone front runs them, the price skyrockets, and the institution gets a terrible entry price. So they don't do that. They use an algorithm to slice that massive order into tiny, invisible chunks.
Right. They might only show 100 contracts to the public order book at a time. So to a retail trader, it looks like a completely normal, insignificant level.
Nothing to see here.
Exactly. But the moment sellers hit that 100 contracts and consume it, the institution's algorithm instantly replenishes it with another 100 and another. And another, the bulk of the iceberg is hidden beneath the surface.
So the Iceberg Assassin module is mathematically hunting for that specific regeneration path.
Yes.
It tracks the constant reloading at millisecond intervals and flags it on the screen, essentially saying, hey, this isn't a small buyer, this is a whale trying to quietly accumulate.
And it does this through a completely revolutionary interface. It doesn't use traditional 2D candlestick charts at all. It renders a full 3D liquidity surface using WebGL, updating every 10 milliseconds. It transforms the flat ledger into a literal topographical map of market psychology.
Yeah, the visual modes are insane. It offers 5 completely different ways to look at this data. You have this standard 3D surface, but then you have wormhole or tunnel flight, which gives you a cinematic view flying down the tape where bid and ask walls rise up like skyscrapers. You have footprint gate for deep volume analysis, X-ray layers, to literally see through the book to spot aged versus fresh liquidity. It's giving you the ability to spot the smart money footprint.
And there is a critical architectural feature here too. Despite being a heavy 3D rendering engine, it runs purely in a web browser. There is zero installation.
Here's where it gets really interesting. It features an aggregate multi-exchange module, right? It takes 5 different venues, Binance, Bybit, OKX, Hyperliquid, and Binance Spot, and merges them into one single unified 3D order book.
Yes, and that is crucial.
But why is that multi-exchange view so critical? Like, why isn't looking at just Binance enough?
Because looking at a single exchange gives you tunnel vision, and institutions exploit that constantly. A massive spoof wall, a fake trap might appear on Binance just to scare retail traders into selling and driving the price down.
Okay.
But the real quiet absorption, the actual buying, is happening simultaneously on Bybit. By deduplicating the trades and merging 5 books into one surface, the software prevents you from getting manipulated by isolated single exchange illusions. You see the aggregate truth of the entire market.
Okay, I have a major point of pushback here. Like, reality check for a second. We are talking about rendering massive amounts of data in 3D, updating every 10 milliseconds. But let's be honest about the retail trader's physical setup. I am trading on Wi-Fi from my laptop. Institutions have microwave towers and fiber optic cables physically plugged into the exchange servers to reduce ping times to microseconds. Visualizing a 3D trap is incredibly cool, but by the time my screen renders the trap and my human brain registers what it is and I click my mouse, the trap is already snapped shut. The game is rigged at the hardware level. Seeing it in 3D doesn't matter if my reaction time is too slow.
That is the most valid criticism of retail trading tools, and it's a very real bottleneck. You cannot beat an institution in a foot race. And the developers behind V7 clearly understood this because the visualization alone is not the core of this system's power.
So it is.
To compensate for human latency, it relies heavily on predictive architecture, specifically something called the Prediction Oracle V2, which was co-designed with a developer named Paul.
So it's not just reacting to what's happening, it's trying to predict what's going to happen next to give you a head start.
Exactly. It projects probabilistic forecasts across 6 simultaneous time horizons. It calculates the probability of a specific price move 5 seconds out, 10 seconds, 20, 30, 1 minute, and 2 minutes out.
That is aggressively fast. Most people think of price targets in terms of days or weeks. This is predicting what will happen 5 seconds from now.
Yeah.
How does it even calculating that without lagging out a standard computer processor?
Well, it utilizes an infrastructure that leaves standard CPUs behind entirely. The AI models run on Cerebrus hardware.
Cerebrus.
Yeah, for context, standard computer chips are usually small squares cut from a silicon wafer. Cerebrus produces wafer-scale engines. They use the entire silicon wafer as one massive interconnected brain.
Oh, man.
This allows for massive parallel processing and sub-second inference. It thinks almost instantly. And if the network gets congested, it routes to Grok, which is another hyper-fast specialized processing unit.
It has to synthesize data faster than my brain can even register the visual on the screen. And according to the docs, it uses a consensus overlord to manage this.
The overlord manages 5 separate AI agents. It's a fascinating approach to artificial intelligence in trading.
I was joking earlier that it sounds like having a boardroom of hyper-caffeinated PhDs inside your browser, but really it's more like a jury, isn't it? Or a team of blindfolded people touching different parts of an elephant. They're all experiencing the same market, but analyzing different textures.
That is a perfect analogy. Each of the 5 AI agents is a highly tuned specialist. One agent is solely looking for spoofing behavior. Another is only analyzing iceberg absorption. A third might be tracking historical price correlations.
Okay, so they all have different jobs.
Exactly. And if the spoofing AI screams, sell, this is a trap, but the absorption AI says, wait, this is accumulation, the consensus overlord weighs their historical accuracy, synthesizes the contradictory data, and issues one final probability score to the user. It resolves the conflict internally.
But AI can hallucinate. We see it all the time with text generators making things up. How do you prevent a trading AI from hallucinating a pattern that doesn't exist and blowing up your entire account?
It grounds those AI models with a live quant engine running in the background. The quant engine ignores the AI's pattern recognition entirely and monitors hardcore objective mathematical metrics.
Like what?
For example, it continuously calculates VPN, which stands for Volume Synchronized Probability of Informed Trading.
Okay, wait. Break down VPIN for us. What is informed trading?
Not all volume is created equal. VPIN separates standard, noisy retail volume from aggressive, one-sided volume that indicates someone knows something the rest of the market doesn't.
Like insider trading or just huge institutional moves?
Both, really. It detects when highly informed institutional money is dominating the tape. When the VPI metric spikes, it warns you that the market is no longer normal, the flow is toxic to market makers, the sharks are in the water.
So it's measuring the toxicity of the environment.
Precisely. The quant engine also monitors a statistical model called the Hawkes branching ratio. This is incredibly sophisticated. The Hawkes process was originally developed to model earthquakes.
Wait, what? Earthquakes?
Yes. Specifically, the probability that a main shock will trigger a series of cascading aftershocks.
And they applied earthquake math to financial sell-offs.
Yeah, because in the market, one massive liquidation trade triggers someone else's stop loss, which triggers a margin call, causing an avalanche. The Hawkes branching ratio measures the probability that the market is entering a self-exciting cascade.
That is wild. And the brilliance of combining the quant engine with the AI is that the software automatically scales down your signal confidence when it detects that chaos.
Yeah.
Like if the AI sees a bullish pattern, but the VPI says the flow is toxic, and the Hawkes ratio says an avalanche is starting, the system tells you, do not trust this buy signal right now. The environment is too dangerous.
Right. It's managing context, not just raw data.
Which brings us to the final hurdle, I think. Because it's one thing to have an AI swarm, synthesize all this data, filter out the hallucinations with a quant engine, and tell you an avalanche is coming in 2 minutes.
Yeah.
It's another thing for you, the human being, to actually execute a trade based on that information without letting your own psychology ruin it.
Oh, absolutely. The human element is the ultimate single point of failure in any trading system. You get greedy when you're winning, you get paralyzed by fear when you're losing, you hesitate when you should pull the trigger.
To solve this, the Auto Trading Engine V7 closes the loop. It hooks directly into the AI and the quant engine, and it actively manages the trader psychology through hard-coded protections.
These protections seem designed entirely to save traders from themselves.
Oh, 100%. Let's talk about reverse mode, because this one blew my mind.
It's a fascinating feature born out of harsh market realities. Sometimes market regimes shift, volatility drops, or macroeconomic factors change, and suddenly your chosen trading strategy is consistently wrong. The signals are just failing.
It happens to everyone.
Right. And if you recognize this, you can toggle reverse mode on. The engine will automatically take the exact opposite trade of what your strategy suggests, allowing you to exploit the contrarian flow instead of just bleeding capital.
It's literally a button that says, I am historically wrong today, do the opposite of what my instincts are telling me. That requires so much humility, but it's brilliant.
It really is.
There's also Smart Martingale, which carefully steps up your trade size after a streak of losses to help recover, though it's strictly capped so you don't blow up your account. But the feature that really speaks to the psychology of trading is the daily PL limits.
The auto flat protection. If you ask veteran traders why most people fail, it's a lack of longevity. They make money in the morning and give it all back in the afternoon.
So true.
With the system, you set a strict daily profit target and a daily max loss. If you hit your profit target, the system immediately flattens all your open positions, cashes you out, and physically shuts the trading engine off for the day.
It locks in the green day, takes the mouse out of your hand so you don't give your winnings back out of sheer boredom or overconfidence. And conversely, if you hit your max loss, it forces you out to prevent tilt. It stops the revenge trading spiral that wipes out accounts.
It is automated and forced discipline. When you look at this entire ecosystem objectively as a case study in the retail versus institutional arms race, it is staggering what is now available outside of Wall Street.
That's exactly how we should frame the pricing of this tool, honestly. We're not pitching this, obviously, but analyzing it as an artifact of this arms race is wild. You stack up the 3D WebGL visualization, the multi-exchange aggregation, the AI swarms running on Cerebra's wafer-scale hardware, the quant engine calculating earthquake math, and the automated psychology management.
Right.
Traditionally, you would need an institutional budget for a fraction of this. A Bloomberg terminal costs something like $24,000 a year. But the pricing for 3D NSUS Meta V7 is 69 euros a month, or a lifetime license for 599 euros.
It represents a profound democratization of institutional-grade weaponry.
Think about that. For the price of a mid-range smartphone, a retail trader sitting in a coffee shop in London can buy lifetime access to an AI swarm that synthesizes global order flow and literally speaks market probabilities out loud to them using a vocal oracle.
It's unbelievable.
So what does this all mean? We started this deep dive looking at the theoretical physics of the order book, how the proximity of limit orders creates immense microstructural pressure. We saw how buyers and sellers use absorption, migration, and traps to fight for price control.
Yeah.
And then we examined a browser-based 3D command center engineered to automate the exploitation of those exact mechanics.
The real takeaway here, whether you ever place a trade in your life or not, is how this fundamentally changes your perception of global finance.
Exactly.
The market is not a flat line on a graph moving up and down based on evening news headlines. It is a living, breathing ecosystem. It is a highly physical space of aggression, absorption, and deception playing out in milliseconds.
It's a war zone, hidden in plain sight. And understanding that leaves you with a pretty wild final thought to chew on. If retail tools like this software are now successfully giving everyday people the ability to X-ray the order book, if an AI swarm running on wafer-scale hardware can instantly expose institutional spoofing and track smart money accumulation, how long will it be before those institutions invent an entirely new, completely invisible way to hide their money? We've seen the ghost, we've built the machine to hunt it down, but what does the next level of this arms race actually look like?